Hi, welcome back. Paul Gerrard from Price Accounting Services. In this video, as part of our rental property investor series, we're going to discuss interest deductions. Okay, this is a fairly long and fairly involved session, so really important one because there's a lot of mistakes people make around interest, and we want to clear up some of those and give you the information so you get it right and so that you can be better prepared. So, first issue is this. Interest is tax deductible to the extent that the borrowed funds were used to acquire the property. So the types of use for the borrowed money could be to pay the stamp duty, to pay the legals on acquisition, to pay for the building itself, to pay for the land, to pay for necessary improvements at the time or thereafter. So, or even the operating costs. For example, when you first buy it, you might have to pay arrears of rates. All that's covered, okay? So, provided you satisfy that nexus between the use of the borrowed money and the acquisition, or related to the costs of acquisition, etc., then the loan interest remains deductible until that is severed. So, how can we sever it? Okay, you often hear people talk about having a mortgage offset account. A mortgage offset account allows you to park savings into a savings account that's tied to your mortgage. And so let's say you've got a $400,000 mortgage, and let's say you're fortunate enough to inherit $400,000. If you pay off that mortgage, it is thereafter non-deductible, okay? But if you put the $400,000 into the offset account, the bank will calculate your monthly interest by saying, well, we've got a debt of $400,000, we're going to charge interest, but hang on, we've got an offset of $400,000, so therefore we won't charge you interest at all. That safeguards your deductibility, because in a month's time, if you decide to spend the $400,000 and buy an investment property somewhere else using cash, the offset account goes to zero, you still have your $400,000 loan. So that's one way to safeguard that. Another issue that relates to interest is where the use of the borrowed money is not for deductible purposes. So let's use an example. You have a investment property and you have a loan of $400,000 on it, and you decide, well, it's gone up in value, it's now worth $800,000. I'm going to draw down $200,000 out of that investment property, and I'm going to go and use that $200,000 to put an extension on my own home. So what was that key test? The use of the borrowed money. So what did you use that new $200,000 for? You used it to put an extension on your own home. That means it's non-deductible. You've merely just used the security of your investment property, not the use of the borrowed money. So it's a really important distinction. The other thing that you've done in that situation is create what's called a blended loan. So you've taken deductible and non-deductible, and it's now in one account. So good brokers, good advisors suggest whenever you create a loan split, in other words, a new amount's borrowed, keep it separate from the original purpose. So you've got your original $400,000 on your investment property, create a new loan of $200,000. So you've got two loans, $400,000 and $200,000. $400's deductible, $200's non-deductible. That's a split. That's a really important feature to avoid mistakes. Other issues associated with interest relate to break costs, and there's video on that. Borrowing expenses, there's video on that. And the other key issue with interest deductions, and it can't be understated, is have a great broker, okay? When you go and you seek additional equity or anything like that, you need the right person looking after you, otherwise you can end up with crossed loans. If you don't know what a crossed loan is, I suggest you find out by asking your broker. Your broker will also ensure that you're going to meet the eligibility for interest only or principal and interest. And that's an important issue now to discuss relating to your deductions for interest. So what's the difference between the two? Well, interest only is what it says. So you merely repay to the bank the interest and nothing else. So the bank charges you $1,000 a month interest and you pay $1,000 a month. An interest-only loan generally will have a fixed duration. Lately, APRA rules have tightened a bit and the banks have tightened a bit and they've pushed their margins up and done a few other little things, but they're discouraging interest-only loans to a degree, okay? But an interest-only loan might allow you to retain interest-only basis of payment for 3 or 5 years. And so if you have a $400,000 loan today, 3, 4, 5 years time, you'll still have a $400,000 loan, you've just paid your interest. And so the amounts you pay are tax deductible because they equal the amount of the interest. Remembering your tax deduction is only the interest, not what you pay. And that's the important distinction with a principal and interest only, principal and interest loan. Principal and interest loan, each month you might be paying $1,200 back, but your interest cost is $1,000. So your annual interest costs might be $12,000, but you're paying more than that. And so over time, your loan balance is reducing. Remembering, of course, you're only claiming the tax deduction for the interest, not what you pay. So, but think of it this way, each dollar of principal you repay is a dollar of equity in your property you're acquiring. So depends on how you look at it, could be a benefit. So they're the key issues surrounding interest. We're going to post some further videos on interest-specific issues under a separate playlist at a later date, but they're the main ones at the present time. So get a good broker, get good tax advice, make sure you're right on track with all your other issues relating to our property series. Use our tax checklist, see you on Property Chat, subscribe to our channel, and we'll see you another time and another video. Until then, bye.